News out this morning is that the Securities Regulation Panel has cleared Nedbank of liability in the case brought against it by the Pinnacle Consortium and a number of individuals. Very briefly, Nedbank was accused of violating the SRP's code on mergers and acquisitions by not making an offer to shareholders of Acc-Ross when its shareholding crossed the 35% ownership level as it covered its exposure to single stock futures. Acc-Ross has since been taken over by Pinnacle Point. For more on this and the banking sector in general, I'm joined from our Cape Town studio by Khulekani Dlamini, Director and Portfolio Manager at Afena Capital. Khulekani, good afternoon. Thanks for coming onto the programme.
Good afternoon.
Well, Khulekani, I'm sure Nedbank's very relieved at the ruling by the SRP. Is it something that's been bothering investors, though? It's been reported that liability could have been very costly, running into the billions of rands.
Oh, absolutely. It was a bit of an overhang risk, but I think in terms of probability, it, in investors' minds, should not have been one of a higher probability. I mean, if you just think about it very practically, the shareholder roster has changed so drastically. It would have been very difficult to track the guys who were shareholders then, and two, the corporate activity that has happened between Acc-Ross as well as Pinnacle Point would have actually just made this whole thing a very, very messy affair. So I think the probability was always low, but it gives investors a sigh of relief to be able to actually be told by the SRP that this has actually gone Nedbank's way.
Do you think this perhaps sets a precedent for future cases? Because in the UK, for example, banks are exempted or excluded from the takeover threshold for provisions for this very reason.
I think, if you have to be very practical about it, think about a bank like Investec. Investec has an asset management business in it. Now, if they were to, for the asset management business, buy up a 30-odd% stake in that particular business, but purely as a trading position, it would be very difficult to then force them to effectively go from having a trading position to having a corporate finance position. So I think in my mind it would actually be something SRP has to think about very, very clearly and make sure that they don't confuse trading positions and corporate finance activities. So this actually underscores, in my mind, the fact that they understand that trading activities are very separate to corporate finance activities.
Of course, you said there was a very low probability of Nedbank not winning the case. And of course, when it came out with results a couple of weeks ago, it hadn't made any provisions for this. So it was probably pretty confident that it would go its way.
Sure. I mean, it does seem like it. And like I said, I think it would have just been a very untidy and a very unwieldy process to actually try and execute on. So I think Nedbank is actually quite clear. And I think they were right in not raising any provisions for it.
Just looking at those results, and of course since then we've also had results up from ABSA, we've had results from Standard Bank as well, and those results aren't really what the market might have expected 6 months ago when the economy was growing a bit more buoyantly than it is now, and when everything looked a lot rosier. It looks like the recovery is taking longer to take effect, particularly in the banking sector. What's your view?
It is actually very true. I mean, in banking as a whole, you actually have three mean reverting factors. The first one is, from a cyclical point of view, just business activity, lending activity. Lending activity has actually been quite low. And because it's been quite low, your turnover, your top line in banks, has actually been negatively affected. The second part that is mean reverting, or should be mean reverting, is the cost to income ratio. Now, if you go back a decade, the cost to income ratio was close to 70%. It has shrunk all the way down to 50-odd%, and this period actually saw a reversal. The cost-income ratio starting to expand again, and that really is a function of turnover being very, very, very slow in the current environment. And then the third mean reverting factor is your net interest margins. Your net interest margins are just getting killed incrementally in this period. One would have expected that they revert back to the historical means. The one thing that seemed to have gone well is the credit impairments. They seem to be narrowing 20-odd basis points here, 40-odd basis points here, the actual impairment ratios. And that actually is what the market was expecting. But the market wasn't expecting an explosion of the cost-to-income ratio as well as the slow sort of business activity on the lending side.
And of course, as you said, banks being affected by that endowment effect, and it really is a catch-22 situation because they really need low interest rates and perhaps even lower interest rates for customers to be confident enough to come and borrow for those big ticket items. But at the same time, that does have the endowment effect on banks.
Yeah, I mean, it actually is quite true. The one thing that one must note at this point is possibly we are at the bottom end of the trough. You know, if you look forward now, 18 months forward, you should expect activity to actually start improving, so your top line should start improving. I think these results should actually bring very sharp focus in management's minds around the cost side. So you probably should expect a little bit more activity on managing the cost-income ratio again back towards the lower 50s. Thirdly, your net interest margin. I'm not quite sure how much room they have to maneuver there, but once again, you know, one should expect that we are now at a trough, a cyclical trough in terms of net interest margins. And then the obvious one is impairments. Impairments, you know, they peaked, I think, in the last 6 months. And from this point on, we should actually see the tailwind come through as they decline. So you should expect some really good earnings growth. And I think the market is expecting in the 20s to 30s for some of these banks in terms of earnings growth 18 months hence.
Of course, at the beginning of the year, we were looking at 20 to 30% growth for our banks this year. Merrill Lynch last week downgrading its earnings estimates, particularly for Standard Bank. It only expects 10% growth this year, 10% this year and 15% next year. Is that in line with your thinking as well?
Oh, absolutely. I think even ourselves, whilst we were slightly more bearish than the market, we probably had to downgrade by a good 5 to 7% our expectations because, you know, lending activity has just been so much slower than expected.
But you're talking about costs and that cost-to-income ratio. In Standard Bank's case, though, international business costs have been rising, and that's really due to an investment for future growth. Do you think this is a good strategy to be investing for future growth at the trough of the market?
I suppose that definitely is it. You know, they say you should double up when the market is at its lowest. You know, you should actually add to your bet when the market is at its lowest. And if you look at the contribution from the Africa and the non-South African business activities, the contribution is actually quite low. And these guys are backing emerging market growth that is significantly faster than SA market growth as well as developed market growth. And, you know, one would expect that they slow down expenditure locally and start spending more acquisitively and in terms of just building out on the rest of the continent as well as some of the other countries, South America, that they're involved in. So it's a good thing to do.
Of course, we're getting FirstRand out next month with full year results. It's got a different year end to the rest of the banks. What are the expectations there? Because obviously that different reporting period must affect what it comes out with.
Yeah, I think the expectation is that FirstRand does do a little bit better than, you know, the other peers. I think FirstRand took the pain earlier for probably a slightly more protracted period than all of the other banks. You know, there were losses on the corporate finance side. There were losses on some of the trading, prop trading side, 700 million rand, I think, in two halves ago. So they took their pain a lot earlier, and I think they repositioned themselves a lot earlier than what the other banks had done. So the market is expecting their growth in earnings to be significantly more superior to the other banks. The one thing to note, just as an aside though, if you look at all the banks now, you know, the expectation in terms of your general upside, it should be around 5, maybe to 20%. Now, you know, if you look at the charts over time, one actually realizes that banks don't ever outperform the market, even if they're growing their earnings as well as they are expected to going forward. They don't outgrow the market once interest rate cuts have halted. So from here on in, you know, you shouldn't expect banks to outperform the rest of the market. Where we actually should have gotten the goodness, the outperformance from banks, was when interest rates were high and as they were coming down. That's when we actually should have gotten the outperformance out of banks.
So at current levels, we have Standard Bank trading around 104 Rand. I think we have Nedbank 130, FirstRand and ABSA's 125, and FirstRand just around 19 Rand. Do you think they're looking fairly priced at these levels? Do you think that they have seen any positive momentum they're going to get for the time being?
Oh, absolutely. I mean, these guys are now trading somewhere between 1.6 to 1.9 times book. And that is really quite fairish, you know, for companies that generate between 18 to 20 odd % ROEs. Price to book of 1.8 is actually a fair level. So yeah, I think at this point you're not going to lose money, but you're not going to make money in excess of what the market should.
Well, one of the smaller banks that has done particularly well with share price has is Capitec. What's your view on smaller banks like Capitec that really seem to be growing at an exponential rate?
Unfortunately, we don't necessarily cover Capitec, but I just think from an outsider's view, they have captured a market that had been largely ignored in the country, and they seem to have used technology to try and mitigate some of the costs that are associated with deploying huge distribution infrastructures across the country. So at this point, we like the idea. We haven't looked at the valuation, unfortunately, so I can't comment on valuation, but I think the business model itself is actually a very good one, and it seems to be borne out quite well, and the market it addresses is also a healthy and growing market.
Well, Khulekani, if you think banks are looking at fairly priced at this stage, where would you be looking for some value in the South African market?
To be honest, it's a very difficult question, that. I mean, the space that I am very familiar with and I cover quite well, ICT space, the opportunities there are also not really that good. You know, you've got the MTNs and the Vodacoms where the expectation is that they should do well going forward on the back of them being able to give you significantly more yield. You've got the rand hedges. The rand hedges have also run, and the upside on them is actually significantly lower than one would expect. I think at this point, you know, it becomes more about stock picking as opposed to making a call on a sector. So it becomes more about looking at individual companies, looking at their primary drivers, looking at the level of normalization in terms of whether their revenue lines are normalized, their margins are normalized, their returns are normalized. And if they are not normalized, then you normalize them and you see if you can get some upside out of that. But from a thematic point of view, it is very difficult to come up with a theme.
Khulekani, thank you very much for your insights this afternoon. That's Khulekani Dlamini, Portfolio Manager and Director at Afena Capital.